So here we are. I'm excited to dive in. I have Carl Memnon, the founder, CEO of Grain Technology. Carl, thanks for jumping on. Do you want to kick this conversation off with a little background on yourself and specifically what you're trying to accomplish with Grain?
Yeah, absolutely. Thanks for having me, Mike. I'm glad to be here. So my name is Carl Memnon. I'm the co-founder and chief operating officer of Grain. Before founding Grain with my co-founders, Christian and Patrick, I was an attorney. I worked on Wall Street. I worked for Goldman for a number of years, then KCG, and then prior to Grain, I was Associate General Counsel at Virtu Financial. They're a global market-making execution services firm. I focus mainly on securities, corporate finance, commercial transactions, things of that nature.
So how do you go from being a lawyer, specifically, how do you decide to give up a great salary and work for ramen noodles and start a company?
Yeah.
What was that decision like?
That was a very interesting decision that I had to make. So my co-founder, Christian, also chief executive officer of Grain, and I actually grew up together in Haiti. And he reached out. We had somewhat divergent paths. I went up to New York and worked on Wall Street. He actually went over to the Bay Area and worked at a lot of startups, fintechs in particular. And he reached out to me with this idea of Grain and thought that it would be an interesting thing for us to work on together, given the subject matter was aligned with what I was doing and also aligned with what he was doing from a product perspective. So.
What was the pitch? What did he say to you?
Yeah, so the initial idea for Grain was always based, there was sort of a general problem around generational wealth. And we were trying to figure out what are somewhat of the underlying problems economically and societally around that. And what kept coming up was credit. And what we discovered that there was a fundamental issue in the credit system that needed to be addressed. And it was both in how credit is provisioned and also the ability for folks to actually access that credit. And, after a number of iterations, we sort of developed Grain, which ultimately is using cash flow, somebody's actual financial wherewithal to underwrite lines of credit.
What is the problem? You mentioned there's a problem with generational wealth. I guess first, what is generational wealth, and then what is the problem?
Yeah, I think the problem is there is an inequity when it comes to sort of the socioeconomics in the United States, and it's passed on from generation to generation. Now, it's not necessarily the wealth being passed on that is problematic. It's the inability for the broader population to access that sort of generational wealth to pass on to their kids and their grandkids, right? And really, fundamentally that starts with credit, right? When you think about, what's most often passed down from generation to generation, that's a home. How do you acquire a home? You have to get a mortgage. In order to get a mortgage, you have to get credit, right? And so, and that's just the low-hanging fruit of examples in terms of how credit impacts generational wealth. But it's a problem that sort of permeates your life generally, whether you realize it or not. Credit, whether it's getting a car, an apartment, a house, a job, is really a factor. And the way the system is currently set up, there's room for improvement. I think, innovating in that space provides a great opportunity for both us as a company and then sort of the population at large.
Yeah. And I think of credit in the abstract sense as kind of currently a centralized reputational system to determine someone's ability to keep their promises, specifically their financial promises. I mean, if you think about it in its most basic, if I'm explaining it to a 5-year-old, that's kind of how I would think about it. And in the U.S., I don't know how it's set up elsewhere, but but I do know here we have 3 credit bureaus, and each of them maintain records of everything about you, where you lived and whether you got a forbearance on a mortgage or how much you made. They have all sorts of information, and it's black boxed. It's very much opaque to me, to the people who have their credit in this platform, and it's vulnerable. It got hacked, and all that personal information for millions of people is on the black web somewhere, I'm sure. Mm-hmm. And it doesn't seem like the end state of where it should be. Do you view the centralization aspect of credit the core problem, or do you view the properties of what these companies are collecting, these credit bureaus, or like how do you pinpoint the problem in the structure of the credit system?
Yeah, that's a very good question. I think there's a number of layers and things I want to dig into on that. I think the first thing that sticks out to me is the fact that what you mentioned, that it's reputational. It's an indicator of past behavior. But when we're looking at credit, the 2 most important things are the ability to pay and the willingness to pay. Now, on a macroeconomic level, there are a lot of things that affect the ability to pay that are independent from the willingness to pay, right? So for now would be the current pandemic. A lot of folks are suffering, right? And so it's not a function of the willingness, but rather the ability, right? And that can be because of student loans, unexpected healthcare costs, a lost job, right? And so that's one aspect. The willingness to pay somewhat tied to the ability to pay. But independent of that, when you look at how we're looking at somebody's credit wherewithal and looking at scores, again, it's the past behavior. It doesn't speak to their current financial circumstance, right? And so taking ability and willingness to pay aside, there's the very practical concern of, okay, what is your current financial wherewithal, right? And a credit score doesn't tell you that. And so what we found is there are a lot of folks who have a willingness to pay, have the current financial wherewithal to pay, but because of reputational, if we look at it reputational, looking at credit scores, they have trouble accessing credit, right? And again, that reputation can be skewed for a number of reasons: inaccurate information, stale information, or something outside of that person's control, economic downturn, unexpected healthcare costs, things of that nature.
Yeah. So the pitch to you when your buddy called you up and said, "Hey, Carl, we have to work on this idea." How did he excite you enough to quit everything you were doing in life and jump into this?
Yeah, I think what was most exciting to me and what I've come to realize over the course of the last 4 years, and what I don't think most people realize is that there are a number of technologies that exist that, if leveraged properly, can really provide innovation in the financial system, and innovation in a way that opens up the financial system to people who are not otherwise in the fold, right? And so when he was pitching it to me, the concepts that I found most exciting is, we can leverage this technology, and this technology to do Y, right? And then, it was incumbent on me to see, okay, how do we bring those things together, right? So I think the most surprising thing or most exciting thing to me was all these technologies that exist on the back end that we can leverage as innovators, and that financial institutions, your run-of-the-mill financial institutions like your community banks, can leverage through a company like us, right? That allows them to compete with the bigger banks, your Bank of Americas, your Chases, your Wells, right? They already have those technologies. To a certain extent, they're leveraging them internally. The small to mid-sized banks are currently not leveraging that technology, and for the most part are unaware that technology exists. And so that's what got me really excited, because I was in that same boat. Understanding, these technologies exist in the background. How can we leverage that to improve the financial system and work with these banks to help them compete?
When you say these technologies, what are you thinking of, or what are you referring to?
Yeah, I guess one that comes to mind is Duola. And it's a money transmitter, but they're very innovative in the way they work. And it's a piece of technology that I did not know existed. And it's fundamental to, how we do business. So that was something I'd never heard of, and I don't think most people ever heard of. Things like RTP and, that is a new technology. And for those who don't know, that's real-time payments. And that's just essentially infrastructure that is being built that would allow for a more real-time transfer of funds. Right now, everything, for the most part, takes 2 or 3 days. But this RTP technology will allow it in more real time, right? In a more cost-efficient way. I think that's probably the biggest point, right? It's more cost-efficient than traditional sort of instantaneous transfers. And so that, that's a new piece of technology that, if leveraged the right way, opens a lot of doors. For example, for grain, leveraging that is going to provide the ability to access credit more readily at the point of sale, right? And that is going to allow us as particularly this initial product, the revolving line of credit, to be an alternative to credit cards in every sense, right? Right now, we've taken the best parts of the credit card and sort of created this new thing. And that will allow us to get closer to that such that really we can replace the credit card, right? When you look apples to apples, grain is a better alternative for a number of reasons, outside of sort of the guardrails that we have in providing a responsible line of credit and things of that nature.
And credit cards are an interesting concept, really, because for many people that have more than the allowance, the credit line on the card, you're not using the card because you need the credit. You're a lot. I mean, when I talk to people casually, at least, people use credit cards because if the card is stolen and somebody uses it, you're not at risk. If you catch it, if you don't have auto pay on, you catch the transaction, you can get it reversed, unlike a debit card in many cases. 2, you get the frequent flyer miles or points and cashback, whatever it is. And then some people have, I'm sure understand this better than I do, but some people can't afford the thing that they're buying, and so they use the credit card to gain credit, and then they pay it back in the next month. That would be if you're living more month to month, if you're younger or have less money in the bank. Are there other benefits to credit cards and those things? I mean, each one of them seem like you can kind of chip at them away, and all of a sudden you no longer need or have credit cards in the world.
Yeah, that's very interesting. I think the way you've described the benefits of credit cards is really in line with the status quo, right? Hey, we have all these fancy rewards. Come use your card, swipe a bunch of time, and get all these fancy rewards. I think the last point you mentioned, which is essentially easing out cash flow, right, is probably of the 3 the most legitimate. And the reason why I say that, and when I say legitimate, I mean in terms of the status quo, because what you said is accurate, right? That is what's known as the benefit, right? But in all 3 of those circumstances, though, thinking of those circumstances as individuals, all 3 of those individuals still need a credit history, still need to build credit. So notwithstanding the fact that they're using it for their rewards, if they did not have a credit card to have a credit history, they would have other issues in terms of access.
Yeah,
right?
yes. That makes a lot of sense to me. In fact, I just found this out recently. My wife had a challenge with it, but you need 3 lines of credit history in order to get a line of credit. If you buy a house or a car or something, they're looking for 3. In the underwriting world, which are the people who make investments in the mortgage, provide the capital for the mortgage companies, they have all these rules, and you don't know what the rules are, but you just kind of blindly submit your application, and then they come back and say, oh, sorry, you only had 2 credit cards throughout your life, therefore we can't accept your loan. And it's like, what rationale does that make? If I paid off my car in full, if I paid my rent all the time, but I didn't have a 3rd credit card, it's like, these rules don't seem to make any sense.
Yeah.
and they seem, I mean, assume this is what you're trying to disrupt, but I'm still kind of clueless as to why these rules exist in the first place.
Yeah, and you're spot on in terms of that's what we're trying to disrupt, right? You said something earlier that I wanted to circle back on. You said it was very opaque, the credit system, right? And that was a perfect example of it. You know, in the background, you can do everything right, but some arbitrary, rule says, okay, well, you don't qualify, right? And so when we look at credit, and what we're trying to disrupt is exactly that, right? And I take a bit further in saying the system at large to a certain extent, right? Because in that circumstance, again, you're not considering that person's actual ability to service the credit you're offering them, right? You're saying in the past, you did not have 3 credit cards, which is, again, a example of reputation, but doesn't really speak to your ability to afford that mortgage now. In fact, having 3 credit cards in the past could be a negative indicator, depending on how you slice it, right? And so when I say we're looking to sort of change the credit system at large, imagine a world where you can walk into a mortgage broker or an auto dealer and connect your account and say, and then the creditor can say, oh, based on your cash flow, this, and the history goes back, right? Based on that, this is how much of a car you can afford, how big of a house you can afford, and right now, how big of a credit line you can afford, right? Because fundamentally, and particularly when you start at credit cards and you look at the mortgage crisis, the problem is a misalignment between what somebody can afford and the credit they're undertaking. And that gets people in trouble, right? That's why there's a segment of our users who have great scores and have great incomes, yet they're grain users. And the reason is they've had the experience of being overextended with a credit card, got into trouble, took time to dig themselves out, and are wary of falling into that unsustainable debt again, right? And so, that goes with credit cards. But we're all aware of what happened with the mortgage crisis, which is essentially, people to a certain extent, and there were a number of factors, but sort of the macroeconomic factor is there is this house with a mortgage that you cannot afford. Granted, there were teaser rates and things of that nature, but the person's financial wherewithal did not match the amount of credit they got, right? And they probably had 3 credit cards in the past. And check all those other boxes, right? But when we're looking at income now, it's not as data driven as it should be, right? You take income, but it doesn't really look at cash flow.
Right. So do you think of grain as disrupting credit cards in particular, where you're kind of our competitors in the space, like Affirm and Klarna, I think is the name of it. I could be pronouncing that wrong. But I think of these companies as when you go to checkout at some e-commerce site, you have the option to pay in installments. Instead of paying $300 for these, this monitor, you pay 10 payments of $30 a month. And then they have their own way of handling that in the back end. Is that, are we triangulating on what grain is doing?
No, and I'll tell you why.
Okay, good.
It's because those products actually offer, whether you call it pay now, buy now, pay later, or whatever you want to call it, they're term loans, right? They're specific. You borrow a certain amount of money, you pay it off over a certain amount of months. Grain is the only product that offers a revolving line of credit that is not a traditional credit card. And so think about the way you use your credit card now, right? You have $5,000 limit, you spend $200, there's some interest charge, you pay it back, that $200 is available to you again. That's how grain works, right? The credit you have is revolving in the same way as a credit card. You have a minimum due every month. That is not necessarily a function of you borrowed, $1,000 and you have to pay $250 every month. It's a function of your balance, your carried balance, just like a credit card is. And so in that way, we're very unique in the market. And what we're doing is unique in that way.
How do you fund it? Where does the capital come from? In the case of credit cards, they're I imagine they're just very large, so they have the capital. Did you have to raise capital specifically for this, or are there partner companies that provide the credit in the back end?
Yeah, absolutely. And that goes to what I somewhat alluded to earlier with respect to us allowing mid-sized and community banks to compete. What we actually do is we partner with these mid-sized banks. They have a very unique problem. They serve their community, right? And historically, they have sort of been the main financial hub for the community in which they serve. In this day and age, financial institutions, particularly the big ones, have much longer reach. And the market share for these community banks is shrinking because they're not able to compete with the technology that millennials and Gen Zs are looking for from a financial institution, right? But their customer base are, largely, what is the word I'm looking for? Baby boomers, people that age. They actually have a lot of capital to deploy, but are unable to deploy it, one, efficiently, and two, to anybody, because nobody's looking for Bank ABC in Arizona for a credit card. They're going to go and get, the fancy card with the rewards from Capital One or Bank of America. Now, the problem is that card may get you into unsustainable debt because they're hedging the risk of not understanding your full financial profile with a higher APR and higher limits to charge you, right? And so that's fundamentally misaligned with the best financial circumstance for that user. And so,
Interesting.
Yeah.
So basically, and I don't mean to distill it down to imply that it's simple, but you're partnering with these smaller banks that have older clientele who are not on the new technology. Let's say there's banks out there that are not the mainstream top 5, and they have capital in their accounts, and you say, hey, look, we'll allocate your capital in a way that can provide a better interest rate return for you. On the other side, how we do that is we advertise to people a alternative to the credit card by getting these revolving lines of credit. And the way that we fund it is through you guys and provide interest. And then I imagine where you spend a lot of time is figuring out what the algorithm is, for how much money I take out. This is my interest rate. These are my, what's the rules of the game that you're officially sort of setting up. Is that right?
That's exactly right. We are the technology intermediary between these institutions and the customers that they would very much like to serve. And indeed, our focus is on the technology, the underwriting algorithm that we developed and patented that looks at individual users, customers, and their financial circumstance to determine, okay, this is how much credit you can afford. So that's exactly right.
Interesting. That's a kind of a complex model. I mean, it's great because it takes advantage of this capital that is not really doing anything. And it's kind of inefficiently sitting in these accounts in these old banks and then using it in a way on the front end that entices people for alternatives to credit cards. Yeah, no, that makes a lot of sense. It sounds really, really exciting.
Yeah, and it's exciting.
Is the target demographic?
Yeah. Our target
totally.
demographic is 24 to 35 in terms of most of our users, but it really runs the gamut. But what I was just about to say is, it's exciting for us, but it's really exciting for our bank partners, right? Because when you think about it, the landscape of community banks is shrinking, right? And we're turning community banks into fintechs, right? In a way that they weren't able to before. And so we're certainly excited, in terms of, it wasn't easy in terms of developing this, but we're very excited about what the opportunity presents, both for providing a different means of accessing credit to our customers, but also the banks and different means of going into the 21st century, providing technology, broadening your customer base, all of those things.
Yeah, I think about local banks because there's a lot of them in this country, and it's not clear to me how they survive in the, say, 20-year time horizon, 20-year plus. Certainly, like you said, there's a lot of people who are probably in their 50s, 60s, who are going to have accounts at these banks for 20 plus years. But it does seem to me that the number of different financial tools out there is going to consolidate. People use Venmo, they use PayPal, they'll use Square. These companies have consolidated the pipes for technology, pipes for finance by building the most efficient technology. And it's kind of this marketplace effect where if you're using Stripe, then it makes Stripe better. And, Apple Pay is kind of the same idea where we all have one of two phones, an Android or an iPhone. And so it kind of falls into this spectrum. And I feel banking is going that same direction where you're not going to want to pay a higher premium in order to have a person inside of a fancy chair inside of an expensive building in your local downtown area. I've used USAA. My grandfather was in the military, so we got into it. It's a nonprofit bank, and they were one of the first to do completely remote. They don't have any locations. They cover the ATM fee. That's pretty sweet. They have no locations. So people, initially you're like, where do I go to do my banking? And I think, what am I doing? I'm not doing any banking. I move money in accounts and take out cash when I need it. But it's, in a way, it's kind of simplifying as people are moving to completely digital worlds. And certainly crypto puts an additional spice in the mix there. So, yeah.
It's funny you say that because, that technological consolidation is definitely happening. So when you think about that, okay, who's set up to survive in that world, right? I think, your top 5, your top 10, maybe 15 or 20 can sort of navigate a world where they no longer have branches because they sort of, they have the technological wherewithal. They've invested in the technology to do so, right? But what about everybody else, right? What happens to your local community bank when nobody goes in a branch anymore and they don't actually have the ability to open up accounts outside of their community to start with because it's a branch, but online generally, right? And I think that day of reckoning is coming. It's somewhat of an existential crisis, right? 50 years from now, 100 years from now, I would say even 25, the number of people going into branches is going to decrease to the point where, perhaps all financial transactions take place remotely, where you don't have to take on the additional cost of having a big building and a bunch of people sitting in this fancy building, right? And then the cost of the financial services are less too. So as it becomes more efficient, it becomes more cost effective for the user as well, right? And so I think it works out for everybody as long as we're leveraging that technology and we're pushing that innovation forward.
Yeah. I almost think in an ideal world, and this we eventually move towards this, we kind of stumble in this direction, is money operates completely in the background and you don't have to go talk or see anybody to get access to the different financial tools that you're looking for. And it's completely reliable. It's not, no one's going to take your money. No account's just going to get shut down. This is less common in the US, but places like Cyprus, I read this article a couple months ago. The Cyprus government just shut down some bank accounts and took the money out of the bank accounts and it's like, that doesn't happen here, but it's not a realistic threat that you or I are probably thinking about, but it's not to say the bank couldn't do it. They could shut down your account. Oftentimes businesses will have their capital shut down in an account for, weeks or months. So I think about that. I think crypto plays a role. I think decentralization of credit has to be the move in that direction. I wonder how the credit bureaus pan out. Do we still have 3 credit bureaus 10 years from now? Are they starting to? Here's the way to think about it, or the kind of the tip of the spear is: will companies who issue loans, like a mortgage company or a car loan company, will they recognize another completely different form or a database of credit? Are they even allowed to legally? I don't know the answer to that. And when will they be able to access, say, like some blockchain credit pull or something? I don't know if any of that makes any sense.
Those are things that excite me. I think, it's interesting. I think the answer to your question is yes, and very soon. One, there are our partners to start, but others are moving in the direction of considering what's called alternative data. I don't think the full potential of that way of underwriting credit has been tapped yet. I think we're one of the first to really go all in with it. But, and I forget who said this, but it may have been Jamie Dimon at Citibank or something. But we've known for a long time now that traditional means of underwriting credit are not as good as they should be, right? It's not as reliable for all the reasons you mentioned. The data at the credit bureaus is, it's dubious, right? Because for a number of reasons. And so the challenge has always been, how do we properly do it? And I think the people working on that problem are like big ships. And so it's hard for them to move, right? But when you bring a disruptor and innovator in it, we're coming up from scratch and saying, okay, this is how we're going to solve that problem. And we can sort of build an infrastructure around that, as opposed to an infrastructure that already exists around a legacy model, right? And it's not to say that they're not trying to move in that direction, but they're not as nimble, right? So everybody knows it works. It's one, who has the sort of the innovative capacity to create a solution around it, and two, who's going to be quicker in moving in that direction and doing it in a sustainable way, right? And that's the challenge.
How does credit work in Haiti? Or tell me more about your experience in Haiti.
Yeah, that's interesting.
Were you born and raised there, or did you move there later in life, or?
Later, well, I was born in New York. My parents moved to New York in the 60s. My mom went to Hunter. My dad went to Pratt. And when I was a baby, I went to Haiti. And so my older sisters grew up a little bit here. And so there's a bit of back and forth between New York. But I'm the youngest, and so when we moved to Haiti, that was sort of the final move. So I grew up, I was born here, grew up mostly in Haiti, but went to an American school. And so my co-founder, Christian, who had a very similar experience, went to a French school. And so what he'll often say is, notwithstanding, we're both from Haiti. The reason I don't have the accent that he has is because I went to American school. And so I somewhat cheated. And so, but yeah, I grew up my whole life there. In terms of how credit works in Haiti, I'll tell you this. I left Haiti after high school, went up to Cornell for undergrad. And so myself, like everybody else, gets no credit education, right? And that's the other thing that Grain does, is we sort of provide guardrails around credit, providing responsible lines so that even if you don't know how to manage it, it manages it for you, right? So all that to say, I don't know what credit was like in Haiti because I never had to navigate, and nobody sought to teach me, because nobody does that in Haiti, nobody does that here, right? It wasn't until, after college, I'm trying to get an apartment, and the security deposit on the apartment was 2-3 times the rent. And I found out that it was because I didn't have credit history. I wasn't able to get a credit card either because I didn't have credit history. Fast forward a few years later, post law school, I got an apartment much more expensive than the first apartment, but the security deposit was a fraction of the rent. And that was simply a function of credit history. And so not having a credit history, what I discovered is it's actually expensive. And unfortunately, it's most expensive for the most marginalized of us currently, right? And so broadening access to it allows people to navigate life in an easier way, from an apartment to a car to a house, all of those things.
Yeah, that's so true that we don't have any. I mean, I was just thinking about my own high school and middle school and elementary school experience. I went to public high school, public middle school, public elementary, and it was just, I don't remember a class on that. There's like finance where you learn about, I mean, I guess basic finance, but it's not, no one ever said this is how you get good credit. This is the point of credit. This is what credit is or how it works. And it is a big part as you get older, especially, and you want to, maybe not just age, but I think about as you get older, your buying more expensive things in life. When you're 18 years old, most people are broke. So, and that's the time to start building a credit history. I still trip up on what it is. Let me ask you this, Carl. Do you think that the government should be more or less involved? Should there be more or less regulation in the credit world?
That is interesting. I'll say this. I think what I would suggest from a regulatory perspective when it comes to financial system, and particularly innovative products, is that I think there's an understanding of these products that's needed, right? And I think that's happening, which is great. I think they should sort of be involved in the way that they have in the past, but develop a framework around new technologies and understanding around new technologies, right? I feel like a lot of the framework that exists is really based on legacy models, legacy ways of doing things, right? And if we keep focusing on that, it sort of stifles innovation rather, right? So what that makes me think of is in the UK, they had a regulatory sandbox. And Arizona had one as well. And we're actually part of the regulatory sandbox in Arizona. We're the second company in it. It's a really great example of how a regulatory body can foster innovation in a responsible way, right? Because what they essentially did is they allowed a space for you to test your innovation, even though there may not be specific rules and regulations around what you're trying to do, because what you're trying to do is new, right? They allow you to sort of test that out within sort of this sort of protective, not necessarily protective, but like guidance of what you should be doing from a regulatory perspective, right? And I think that's been huge in the UK, that program. And now those companies that are graduating are now coming over stateside, right? And acquiring U.S. consumers, right? And so I think stateside, to sort of remain competitive, particularly when it comes to financial innovation, more programs like that would be very helpful. I think encouraging those people.
Yeah, a lot of times when you're building, especially in finance and healthcare, those are the two that come to mind because they're very intimate. Your financial situation and your health are probably the two most intimate parts of a human, and there's a lot of regulation in both areas. Mm-hmm. And to your point, it's kind of the regulation is the repercussions of the bad things that happen from the old way of doing things. Yep. And then today in the financial world of crypto, it's like I started a crypto company and it was very frustrating trying to play within the rules because you don't really know what the rules are. And to some extent, I think that's not a bad way of doing it if there's not punishment for breaking a rule that doesn't exist. In some ways, I think the U.S. was very successful with the emergence of the internet. The internet was invented here, and it is obviously flourishing now. And it was, in part, the flourishing was due to a reactionary regulatory perspective. Mm-hmm. Instead of saying, hey, we're going to determine the rules before you even play the game. It's like, look, play the game. We understand that some people are going to get hurt. Some people are going to lose their money. Some people, bad things will happen. But when they happen, we'll come in and we'll figure out what the right way to handle that is. And I think that you have to have, whenever you go into a world where you're building new stuff, you have to take on board, you have to accept that things are going to go bad, but that we're going to bend, not break. That'll happen. When it happens, then we'll call attention to it and we'll say, hey, we need a rule or regulation for this specific thing, instead of trying to, A, don't make any rules, or B, make the rules before you start building. So the sandbox seems like a good point. It seems like a great way to do it, honestly, is kind of have a really, I think of it, ideal world from an entrepreneur's perspective, I think, is have an informal but honest conversation thread going with the rule makers, the regulatory bodies, when you're building. Instead of it being so formal, everything was so formal. If you wanted to get a response on whether your business model was legit, you'd have to send a request in. It takes months to get back. It's like a letterhead. They, formally document it. And I get it to some extent, but it also it's slow and treacherous and nerve wracking. So I
get that. I think I have a little bit more appetite to that as a lawyer, right? So I appreciate the process in a way that I think most people don't, right? And I get why, right? Because sometimes it can seem onerous for no reason. But I think the larger point that you make is one that we have tried to employ from the very outset, which is an open line of communication with your regulators or even potential regulators, right? Because we're really just a technology company, right? But just because we're in the finance space, I think it's important to keep them informed and keep that open line of communication, right? Because ultimately, if you're doing the right thing, regulators they're regulators, but they can be partners in regulation too. It doesn't necessarily need to be an adversarial relationship with regulators. And I feel like, some people come into it with that and then try to, outsmart or do something, try to call something what it's not, or, I think doing those things sort of builds distrust when rather sort of approaching relationships with regulatory bodies as collaborative, and understanding that, both sides, where it applies, both sides are trying to create a better, financial system, right? I think that can be very powerful, right? And the sandbox, like I said, is a good example of that. But the biggest example I've seen is in the UK and what they've done with their sandbox. And so I'm a big advocate of expanding sandbox programs and work.
Yeah, I'm curious your perspective as a lawyer here. I sometimes I wonder what it's like on the other side of the table, on the regulatory body side, thinking about what is every organization that people cooperate together to achieve something. There's there's usually a set of guidelines, a mission statement. This is the purpose of what our organization is. I wonder what it's like internally and where the fringe cases are. For instance, say in the FCC, or pick any 3-letter regulatory body in the U.S. government. If they go too far on one side, they overregulate. There's too many rules, stifles innovation. People suffer because we forego opportunity, and there's not the products in the market. If you go the other direction, there's too little regulation. People can take advantage of each other. People can steal from each other. What else happens if there's too little regulation?
Yeah, or things can just break and not work properly.
Things can break. Yeah, right. Yeah, things can get stolen more so. So I'm curious your perspective on lawyers. So do lawyers have what's for the person who just interacts with, their credit card and they're working at wherever they're working, they don't interact with a lawyer on a day-to-day basis. Lawyers, I kind of view them as the glue to society. They're holding they're holding the organizations together. If you do a partnership, or if you acquire a company, or if you raise money, it's always lawyers involved, because you can't just raise money. You can't just buy a company and not involve lawyers. It's like fundamentally you need the lawyers, like, cement the ways that organizations connect with each other. I don't know if this is making any sense or if you agree with me.
No, it
tell
makes
me
a ton of sense.
What do lawyers do?
It makes a ton of sense. The reason why that makes me smile is at the same time, everybody hates lawyers, right?
Yeah, everyone hates lawyers.
But what you're saying is true. There's very little sort of transactions or interactions besides like the most sort of mundane retail transactions that don't involve a lawyer. And even your retail transactions, you don't realize, but the parameters of that, that transaction, there was a lawyer behind it when it was set up, right? So you don't need a lawyer every time you go to a store or McDonald's and buy a Happy Meal. But there are certain parameters around the point of sale and the costs and things like that, lawyers are at some point involved. It's not a free-for-all, right? I think the interesting thing being in fintech, and it's a funny thing that we say around the office, is, most people in fintech are product managers, engineers, operators. I'm very much an outlier in being from New York, Wall Street lawyer and working in fintech. And that's just a function of my co-founder who's there and knew me and called me to work. And as a result of that, I have a very compliance-focused approach to building our company that you may not find elsewhere, right? And so the joke is somebody else gets in trouble, it's like, oh, they must not have a Carl, right? Because I'm coming from that perspective, right? The idea of build fast and break things, or whatever that moniker was.
Yeah, that's exactly right.
It sounds great. But to a regulator, that doesn't sound great. And what are you breaking, right? You certainly want to innovate and build fast, but there's nothing wrong with deliberate haste, right? You can move quickly, but deliberately, and in a thoughtful way, right? And I think that's one of the things I love about our team is we're balanced in that way, right? And my other co-founder, Patrick, he's our CTO, he's our engineer, so he's very much into that Bay Area world, but he worked for 13 years at Goldman Sachs, right? And so he understands the other side of it. And so with the three of us, we've been able to navigate that in a way that allows us to be innovative, but that also allows us to be sort of responsible, party in this, financial system.
Yeah. What makes Goldman successful? They seem to be, I don't know a lot about Wall Street finance, but I know Goldman stands out as sort of the premier shop. Do they have something internally with their culture or the way they organize themselves, or what is it about them, do you think?
Yeah, I mean, it's hard to say. They've been around forever, right? And so, there's a little bit of reputation and generational capital passed down from, generation, like my dad probably knew Goldman, right? And, my kids will know Goldman. But I think in terms of a culture, one thing that I will say is that there is a heavy focus on work ethic, right? I think, they are and producing at a high level of excellence, right? I think, and I think that's very important. But one of the things that, both Patrick and I sort of bring from that world, but want to make sure that we have and instill in our company culture, is that you can have that high level of excellence, but also have fun, right? It can be sort of, those two things aren't mutually exclusive, right? And so at Grain, all our, 30 some employees, we're a small team, we're growing very quickly, but each one of those individuals functions at a very high level of excellence, right? In order to sort of build this thing, to disrupt this thing that we're trying to disrupt, right? And so we brought that, but at the same time, we have lots of fun. As a team, we really enjoy what we're doing. We love working together. And that's one of the things I really appreciate about, this sort of, new role, new journey that I'm on, is that those two things, work can be fun. You can be excellent at work.
I take it Goldman wasn't as fun. They didn't emphasize fun as much as you.
I mean, I don't think Goldman's known for its fun, right? No. I don't think
fair point
with that. But everybody has an opinion about Goldman, and I'm not saying one way or the other. But I will say that it did teach me that, one, excellence is important, but moving here and having this sort of experience has taught me that fun and enjoying what you do is also important. And those two aren't mutually exclusive. And not to say that it is at Goldman, but I'm able to navigate that better here.
Yeah, awesome. Good for you, man. It sounds like a really great mission you guys are on, coming at it certainly from the right motivation and the right innovative product. So yeah, congrats on all the progress. If I have you back on in say 5 years, what impact do you hope that grain would have in the world?
Oh yeah, in 5 years, I hope one, we are a true alternative to the credit card, meaning that when you're considering your Bank of America, your Chase, your Capital One card, you're considering grain as well. And two, we've been able to fundamentally change how credit is underwritten, meaning you can come into an auto shop, a mortgage, wherever, and with good cash flow, and say, hey, I want to apply to get this car. And you would be able to do that and be underwritten in a way that is independent of the three boroughs, right? And is based solely on your cash flow and your ability to service that loan.
Awesome, man. Well, the website is Try Grain. I really enjoyed chatting with you about credit and the abstract purpose of government. We covered some good ground today.
Yeah.
So thanks for hopping on, Carl.
Thank you for having me.
Awesome.
Of course. Thank you for having me.